Insurance scores. Insurance scores are confidential rankings based on credit history information. They are a measure of how a person manages his or her financial affairs. People who manage their finance well tend to also manage other important aspects of their life responsibilities, such as driving in a car, combined with factors such as geographical areas, previous crashes, age, and gender. Insurance scores enable auto insurers to price more accurately so that people less likely to file a claim pay less for their insurance than people who are more likely to file a claim. For homeowners insurance, insurers use other facts combined with credit such as the home's construction, location, and proximity to water supplies for fighting fires. Insurance scores predict the average claim behavior of a group of people with essentially the same credit history. A good score is typically above 760 and a bad score is below 6,600. People with low insurance score tend to file more claims, but there are exceptions within that group. There may be individuals who have stellar driving records and have never filed a claim, just as there are teenager drivers who have never had a crash, although teenagers as a group have more accidents than people in other age groups. Credits report information who wants it. It is becoming increasingly important to have an acceptable credit record with whether we like to it or not. Society equates the ability to manage credit responsibility with responsible behavior, even if individuals have a bad credit record through no fault of their own. Landlords often look at applicants' credit records before renting apartments so to see whether they manage their finance responsibility and are therefore likely to pay their rent on time. Banks and other lenders look at the credit records of loan applicants to find out whether they are likely to have loans repaid. Some employers also look at credit records, especially where employees handle money, and view a good credit record as a measure of maturity and stability. In some insurance companies, underwriters have long used credit records in cases where additional information was needed before the development of automated scoring system. Underwriters would look at the data and make decision, often earning on the overly caution side that disadvantages many more people. Automated insurance scoring and underwriting system eliminate the weakness inherent in someone's personal judgment and have allowed more drivers to be placed in preferred and standard rating classification, saving them money. With the development of these scoring models, the use of credit related information in underwriting and rating for many insurers has become routine. Insurers use insurance scores to different extent and in different ways. Most use them to screen new applicants for insurance and price new business. Why insurance need it? Insurers need to be able to assess The risk of loss risk of possibility that a driver or a homeowner will have an accident and file a claim in order to decide whether to insure that individual and what rate to set for the coverage provided. The more accurate the information, the closer the insurance company can come to making appropriate decisions. When information is insufficient, applicants for insurance may be placed in the wrong risk classification. That means that some good drivers will pay more than they should for coverage and some bad drivers will pay less than they should. The insurance coverage and some bad drivers will pay less than they should. The insurance company will probably collect enough premiums between the two groups to pay claims and expenses, but the good drivers will be subsidizing the bad. By law, in every state, insurers are prohibited from setting rates that unfairly credit scoring discriminate against any individual, but the underwriting and rating process are geared specially to differentiate good risk from bad risk. Since insurance is a business, insurers favor those applicants that are least likely to suffer a loss. One of the key competitive aspects of the personal lines insurance business is the ability to segment risk and price policies accurately according to the likely cost of claims generated by those policies. Insurance scores help insurers accomplish these objectives. Earthquakes, risk and insurance issues. An earthquake is a sudden and rapid shaking of the earth caused by the breaking and shifting of rock beneath the earth's surface. This shaking can sometimes trigger landslides, avalanches, flash flood, fire, and tsunamis. Unlike other natural disasters such as hurricane, there are no specific season for earthquakes. Earthquakes in the United States are not covered under standard homeowners or business insurance policies. Coverage is usually available for earthquake damage in the form of an endorsement to a home or business insurance policy. However, insurers that do not sell earthquake insurance may still be impacted by these catastrophes due to losses from fire following a quake. These losses could involve claims for business interruption and additional living expenses as well. Cars and other vehicles are covered for earthquake damage under the comprehensive part of the auto insurance policy. In the United States, about 5,000 quakes strike each year. Since 1900, earthquakes have occurred in 39 states and caused damage in all 50. One of the worst catastrophes in US history, the San Francisco earthquake of 1906 would have caused insured losses of $96 billion were the quake to hit under current economic and demographic conditions according to AIR worldwide. The potential cost of earthquakes has been growing because of increasing urban development in a seismically active areas and the vulnerability of older buildings, which may not have been built or upgraded to current building codes. The Northridge earthquake, which struck southern California on January 17, 1994, was the most costly quake in US history, causing an estimated $20 billion in total property damage, including 12.5 billion in insured losses. In its wake, the California Earthquake Authority (CEA) was created in 1996, fearing insolvency from another massive earthquake. The vast majority of insurance in the state's homeowners insurance market had severely restricted or caused writing coverage altogether after Northridge to ensure the availability of homeowners coverage and a serious threat to the vitality of the state's housing market. The California legislature established the CEA as a publicly managed, largely privately funded entity. Only about 20% of California now purchase earthquake coverage, down from about 30% in 1996 when the devastating 1994 Northridge quake was still fresh in people's mind. To encourage more California to buy the coverage, the CEA approved an average 22% rate cut, which went into effect July 1, 2006. The CEA says that a sharp drop in the cost of reinsurance than several years without a major quake, allowing the build up reserves, made the cut possible.